Have you ever wondered if you are paying too much to invest your money, or how to choose an investment vehicle that helps keep more of your earnings in your pocket? Understanding the costs associated with different investment options is key to building wealth effectively. When comparing the costs of mutual funds and exchange-traded funds, or ETFs, it is important to know that while both have expenses, their structures lead to different ways these costs are incurred and impact your investment returns. Generally speaking, ETFs often tend to be the lower cost option, especially for passively managed investment strategies. The primary mechanism behind these cost differences lies in their operational structure. Mutual funds are typically bought and sold directly through the fund company or a broker, often priced once a day after the market closes based on their net asset value, or NAV. Their costs can include an expense ratio, which is an annual fee for managing the fund. Some mutual funds also charge sales loads, which are commissions paid to a broker. These can be front-end loads, paid when you buy, or back-end loads, paid when you sell. Additionally, they might have 12b-1 fees for marketing and distribution, and internal trading costs within the fund, especially if it is actively managed, meaning a fund manager is frequently buying and selling securities. On the other hand, ETFs trade like individual stocks on an exchange throughout the day. Their costs usually involve an expense ratio, which is often lower than that of many mutual funds, particularly for those ETFs that track a market index. When you buy or sell an ETF, you might pay a brokerage commission, though many online brokers now offer commission-free ETF trading. You will also encounter a bid-ask spread, which is the small difference between the highest price a buyer is willing to pay and the lowest price a seller is willing to accept. Because many ETFs are passively managed and track an index, their internal trading costs and management fees tend to be lower. To help you make an informed decision, here is how you can compare their costs directly. First, always look at the expense ratio, expressed as a percentage, as this is a recurring annual fee for both. For mutual funds, check if there are any sales loads, either when you buy or sell, or any 12b-1 fees. For ETFs, find out if your brokerage charges a commission for trades, and be aware of the bid-ask spread, which can add a tiny bit to your cost, especially for thinly traded funds. Also, consider the tax efficiency. Due to their unique structure, ETFs often have an advantage in how they handle capital gains, which can impact your after-tax returns over time. Ultimately, choosing between a mutual fund and an ETF often comes down to your investment strategy, how often you plan to trade, and your personal preference for active versus passive management. By understanding terms like expense ratio and bid-ask spread, and knowing where to look for potential loads and commissions, you empower yourself to select investment vehicles that align with your financial goals and help you keep more of your hard-earned money growing for your future.